This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 102.5 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans. Or you can talk to him right now at 407-916-5400.
Well, good morning. Happy 2018 from us here on Dollars and Cents. That would be me, Joel Garris, and to you, our listening audience, as we enter another year in the program. What a start to the year, huh? My goodness. If you listen to last week's program, you know that was the last program of 2017, before 2018 had started. We like to do our fearless forecast, which is our tongue-in-cheek exercise as to sort of what we think the markets are going to do. And at the time, just a week ago, we said 27,300 on the Dow. So then a week goes by. It wasn't even really a week, right? It was 4 days. Because the first day, Monday, was a holiday and the markets were closed. And Dow proceeded to go up over 575 points. So that makes my 27.3 look like it might be a little bit easier to get to, especially since I get a 575 point head start in the first 4 days. That's not too bad, right? There's a lot of the year left, though. Yes, there's a lot of the year left. But certainly, this start to the year was one of the better ones that we've certainly seen in many, many years. Be careful on the math these days, folks, because when the Dow's at 25,000, 100 points doesn't mean as much when, say, the Dow was at 10,000. Right? I mean, just the sheer math, right? It just doesn't mean quite the same. So 575 points on the Dow, when it's at these particular mathematical levels, works out to be 2.3%. So, good week. I mean, that's for sure. But 576 points on the Dow when it's at 10,000 would be like nearly 6%, which would be an incredible week. So just be careful on the math. And I understand that obviously when you break a round number plateau, particularly 25,000, that it catches people's attention. It generates a lot of conversation in the media. What's driving that? Obviously, the same kinds of themes that we've been talking about for many months now, and that is better corporate earnings, that is better consumer sentiment, that is better economic conditions, really worldwide. But what's kind of fascinating about this movement and the Dow. And remember, the Dow just represents 30 stocks. There are other indexes like the S&P 500, which, as the name suggests, represents 500 stocks. The NASDAQ, for example, represents nearly 7,000. So in terms of broader indexes, the Nasdaq was crossing over 7,000. Excuse me. The in terms of broader indexes, there are some out there, that would be a much greater indication, and those, by the way, also experience some strong growth as well. The S&P 500 was up 2.6%. The Nasdaq was up 3.4%. So even those broader indexes this past week actually had an even better week than the Dow. But what's fascinating about the Dow is sort of what's been driving it. Okay, so remember it's 30 companies, right? And it is the way they calculate it. It's not like if you had like 30 grades, right, and then you average those grades, and that's your grade for the quarter. Okay, it's not like that. It's not the traditional mathematical averaging that we would typically think of. It is kind of a price weighted type of calculation. So it's a price weighted market share type weighted calculation. And so what's fascinating about the latest move, particularly the last 1,000 points, if you will, that happened within a pretty short period of time, is the top three contributors are companies that you would say, well, those don't sound like exciting companies. Those sound like companies that have been around forever, that don't really have a big tech piece to them, and are generally durable goods or consumer goods. And so when you look at it, what's kind of fascinating is it's not your traditional Facebook, Amazon type stuff. Well, first of all, because Facebook and Amazon aren't part of the Dow, so it's hard for them to contribute to the performance of the Dow. But the big ones so far over the course of the most recent increase, Boeing, Caterpillar, Home Depot. Those are the three biggest contributors to the movement in the Dow over the course of the last 1,000-point increase. So those are very traditional, right? I mean, Boeing, they make airplanes. Caterpillar, they make, like really big trucks. And Home Depot, they sell hammers and nails. So it's kind of interesting to see some of these, I guess, traditional, dare I say, old school type companies that aren't some, fancy drone flying company that's going to drop packages at your door or something. It's kind of interesting to see the more traditional goods companies, if you will, contributing the most to the increase in the performance of the markets. Here's what's sad, okay? And this was a headline in Friday's Wall Street Journal after the market had passed the 25,000 record, is the headline right below the chart, big chart, Dow hurdles past 25,000 to record. That's sort of the top headline. But on the top half of the fold, which is supposedly where all the news people like to put the important stuff, is top half of the fold, right? I mean, that's where it's got to be. The other headline on the top half of the fold is entitled, "Many Investors Bailed Out Early." You've heard us talk about this before, but the numbers are staggering. Nearly $1 trillion has been pulled from retail investor mutual funds that target U.S. stocks over the course of the past 5 years. Over that same period, the article continues, the S&P 500 soared 116%, and along with the Dow and the Nasdaq, rose to 190 all-time highs. That's the hard story. That's the hard story. because many investors bailed out. Many investors were not consistent. Many investors got distracted along the way. And that is the unfortunate part of this story. This fear over short-term volatility. And we're going to talk a little bit more about that in the next segment in the program. Okay? This fear, because there's a fascinating statistic that we're going to share with you on that. This fear of short-term volatility, okay, the boogeyman in the closet, if you will, causes people to make really bad decisions with their money. You've got $1 trillion that, and remember, we're talking about mutual funds, right? So mutual funds, we're not talking about institutional money, okay? We're not talking about pension funds. We're not talking about the big boys, so to speak. We're talking about normal people, you, me, your neighbor, your coworker. Those folks are traditionally likely to invest in mutual funds because of the accessibility that mutual funds bring to the table, the diversification. It's the option in your 401k. And so when you look at that the mutual fund outflow, that's a pretty good indicator of the individual or, kind of the normal person. And when we look at the outflow, $1 trillion out, all the while the market was going upward. And instead, we get stupid stories and people clamoring to get in to stuff like Bitcoin. Meanwhile, Boeing, Caterpillar, Home Depot are driving the Dow to record high. What do you want to own? Something that doesn't have anything behind it? But the number of calls and the number of excitement, the number of investors trying to figure out a way to get into Bitcoin. Meanwhile, $1 trillion is fleeing companies like Boeing and Caterpillar and Home Depot. By the way, that's one of the biggest indicators in our view of why we don't believe, combined with the economic data, which we think is very strong, and why our fearless forecast last week put the Dow at 27.3 for the year. One of the sort of non-economic factors that we look at in making that fearless forecast is everybody clamoring to get in? Is everybody clamoring to get in? And they're not. They're not. And usually, market peaks are not made when people aren't participating, right? I mean, the stages of a market, typically you have to get to that stage of euphoria or should we say greed before you will see a fundamental disruption in the market. There always is that kind of that final phase of euphoria and excitement, and everybody's talking about it, and everybody's getting into it. But when we look at flows, $1 trillion going out over the past, exiting over the course of the past 5 years, it's not exactly folks clamoring to get in. And unfortunately, a lot of people have missed it. Why? Because they're always afraid of the next headline. We'll talk about that next headline when we get back here on Dollars and Cents. This is Joel Garris with Nelson Financial Planning here on News Radio 102.5 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 102.5 WFLA. And then, of course, to our friends on the AM dial, 540 AM as well. This is your host, Joel Garris, during Monday through Friday. I'm at the office at Nelson Financial Planning. Here, though, it is Sunday, which means we're sitting in the wonderful Clear Channel Studios in Maitland, Florida. We're talking about the events of the past week, right? First week of the year, Dow moving pretty solidly upward, 575-point gain for the Dow, breaching the 25,000 mark. That's the good news. The sad news is the other headline on the Wall Street Journal on the same Friday yesterday, 2 days ago, talking about going past 25,000. Many investors bailed out early. Why? Because they're always concerned about the headline that the media is going to take and exacerbate and stir the pot and all those kinds of things. And it's interesting, if you look during the course of the past 12 or 13 months, there's been more than a few shares of headlines, right? Seems to me they publish the newspaper every day, that would certainly catch our attention and make us question the viability of the economy, the markets, the guy who's running the country, the guy that's running a country on the other side of the planet. I mean, you name it, right? I mean, those are the headlines. But here's what happened despite all of those headlines. It's tossing a couple of natural disasters and the like. Here's what has happened during the course of headlines. So we've gone 395 trading days. Okay, 395 trading days. Now be careful because we're talking trading days. So 395 trading days are how many weeks is that? Well, there's usually 5 trading days, right, in a week. So we're talking about 79 weeks or about a year and a half, okay? So that goes back, year and a half would go back to what? That goes back to like August of 2016, okay? So Obama's still president, okay? Nobody thinks Trump's going to win. I mean, think of all the headlines that have happened since then. But yet, it has been an abnormally smooth ride for the market. In fact, the S&P 500 on Friday set a record, marking the longest stretch in history that the market has not fallen 5%, at least 5%, within any 6-month period. The old record was 394 days. Certainly the year 2017, in particular, the past year and a half, have not really had a whole lot of volatility in any way, shape, or form. Okay. The last time that the S&P 500 lost at least 2% in a single day was nearly 2 months before the presidential election. There were only 4 days in 2017 with at least a 1% drop. To compare that, if we look at the prior 30 years, on average, there have been 1% drops every 7 or 8 trading days, and a 2% drop on average about 10 times per year. Let me say those statistics again, okay? So the average occurrence of a 1% drop, looking back over 30 years, is about 7 or 8 days. So every couple of weeks, all right? A 2% drop in a given day happens about 10 times a year, about once a month. We have to go back to September of 2016 before we will find a single day where the S&P 500 lost 2%. And there were only 4 days in 2017 with a 1% drop. So the lack of volatility, when you stop and think about it, think about all of those headlines that happened over the course of the past year and a half. And yet there was not much reaction, basically hardly any, in the overall markets. Now, has volatility in the markets disappeared forever? Of course not. Okay? Of course not. So be careful, because when even that normal level of volatility returns, folks in the media are finally going to say, thank goodness we've got something else to talk about, because, it won't be cold, so we can't talk about how cold it is, about weather. We need something to talk about. So the first sign of any volatility in the market, you're going to hear a lot about it. And sadly, that's going to continue to make the headline from Friday's Wall Street Journal continue to be true, where many investors have not experienced any part of this improvement in the market. Because the second the volatility hits, you're going to hear dramatic reaction. Oh, my goodness, this is going to be 2008 all over again. As sure as I'm sitting here, 9:30 on a Sunday morning, you're going to hear that. The second there's a couple of days or so. Let me tell you now, that is a normal part of the market. It is. The statistics on it are overwhelming. Let me also tell you that it should not be a reason to detract you from your investment goals over time. And this is where people get it. They just mess it up, because they get so fixated on what the market is doing in the short term that they forget that this money that they are investing has got to work for them for 10 or 20 or 30 years. I always love it when folks in their 60s come into the office and tell me that they are retiring so that they need to get out of the stock market. And I said, well, that's fine if you want to resign yourself to lower returns. And they said, well, wait a minute, I'm retired. I just don't have the time to recover. And I said, well, wait a minute. Okay, here's what we know about life expectancy in this country. If you're a married couple at age 65, one of you will make 85. That's the statistics. Married couple, age 65, one of you is going to make age 85. So that, if I've got my math right, is 20 years. Seems to me that whatever the short-term volatility in the market is, that you want to be investing for that 20-year time frame. Far too many people don't take that perspective. Watch the short-term volatility. Don't get too excited about it. It's going to happen. As sure as I'm sitting in this chair, it's going to happen. But the reality is that it is always time in on your investments, not timing. Don't worry about where the market's going to be next week, next month, next quarter, or even next year. Where is the market going to be 10 years from now, 20 years from now? The reality is it's a reflection of the economy. And from that perspective, that's where you should be making your investment decisions. Don't be part of this group that misses out. Be careful of the short-term volatility. And I think that's important. Let me be clear on that. Okay? I think there's ways to do that. If you're invested, then you stay invested. Don't try and time the market. You'll get that wrong every time. If you're not invested, then perhaps you consider dollar cost averaging in to the market. So you don't get buffeted too hard by short-term volatility. Something to think about there. We will slide to the break. When we get back from the break, I want to talk about a couple of things that we have been trying to get to over the course of the past few Sundays, one of which is about Social Security, one of which is we want to go through in broad strokes some of the rules that you've got to observe on your pass-through entity in order to get the lower tax rate. We're going to try and cover all of that when we get back here on the program, Dollars and Cents, with your host, Joel Garris of Nelson Financial Planning here on News Radio 102.5 WFLA.
WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back, ladies and gentlemen. Dollars and Cents. This is Joel Garris of Nelson Financial Planning. You're listening to News Radio 102.5 WFLA. Busy morning on the program this morning talking about the markets going past the 25,000 mark and also talking about volatility and the lack of it. And just to repeat what we were saying before the break, you know, there are some strategies to think about, particularly if you're not invested and you're trying to figure out, you know, about getting in to the market or changing your investment allocation, that ultimately the one that we feel pretty strongly about is more appropriate. And which means that you're not sitting, 60, 70, 80% on the bond side. That's ridiculous. The only reason why you're sitting there is because the masses in the financial services industry don't really fundamentally care about how much money you're going to make. They just don't want to have to deal with the call that happens when there is a volatility in the market. And it's shameful, but that, folks, in our view, has been the trend in the business for the past 10 years. And many investors have missed out on the improvement in the markets that has happened over that period of time. And so if you're invested, you stay invested, period. No caveats to that. You're invested, you stay invested. Okay, maybe you look at your investment allocation or your investment portfolio and say, well, is this doing as good as it could? Okay, fine. That's always a great exercise to do. But if you're in cash and you're trying to make a decision, there's not ever going to be a right or wrong answer on that. But what you can do is you can think about trying to dollar cost average or use somewhat of a strategy like that to help yourself get into the markets without feeling like you're going to get caught or caught up in short-term volatility. There is always a difference between short-term volatility and what we refer to as longer-term or economic volatility, because economic volatility results in much more dramatic reaction in the market. As we look out on the economic landscape, certainly the Fed could screw this all up pretty bad, but beyond that, when you have corporate profits rising, consumer spending rising, and generally a global economy that's moving forward, it's pretty good. But we are, of course, a call-in program. I always forget to give out the numbers. I get going off on my, monologues and then forget. But Olin, fortunately, knows that we are a call-in radio program, and so he decided to call on in this morning. Olin, welcome to the program.
Oh, good morning, Joel. Thank you. You had talked earlier a little bit about Bitcoin.
Yes.
And I'm an investor, but not in Bitcoin. And all the articles and everything that I've ever read about Bitcoin, I'm always more confused after I read the articles. And I just don't understand the concept of it. In the back of my mind, I'm thinking, is it a Ponzi type, a variation of a Ponzi scheme where people willingly go in and buy the Bitcoin with the hopes that it'll go up, and then it's just a confusing issue. And I'm not the brightest or the dullest crayon in the box, but I just don't understand it. I wouldn't invest in it, not really.
No, and I think you're right. I wouldn't think of it as a Ponzi scheme, where, okay, if I get money from these investors, I can then use that money to pay the first investors, and I keep the circle going until something happens and it implodes. That's kind of the traditional format of a Ponzi scheme, where you get people in early and then use the subsequent investors to pay the first people, and then they're very excited, and then more and more people come in, and then eventually.
How about a gold rush, Joel?
That's probably a better analogy.
In the California in the 1840s, the gold rush. I didn't mean really strictly a Ponzi scheme, because the people willingly go into it. They're
that's exactly right. And when I did I think probably about 3 or 4 weeks ago, I talked about it at length on one of the shows. I actually compared it to the tulip bulb mania back around the 1500s in Amsterdam, where everybody got very excited about tulips and the price of tulips, and it just went astronomically through the roof. But Olin, here's kind of how the concept of Bitcoin works. First of all, it was created to be used as a mode of exchange. Okay, so much like the dollar, right, is a mode of exchange. If I go into a store and I give you $1, then I'll get a cup of coffee. Bitcoin is intended to be another mode of exchange, like the dollar. Okay. The problem is that the U.S. dollar is backed by a 25 trillion economy and a pretty industrious nation, along with a federal government that has the ability to tax that industrious nation. Bitcoin doesn't have any of that, right? So there's nothing backing Bitcoin. And the way that they've sort of set that up is there's basically 21 million Bitcoins out there available. And so when you restrict how much is out there, then you can effectively sort of help drive up the price if you can get a lot of people interested. Yeah, like the tulips. Sure.
I remember that show when you
Yeah. Yeah. So what it
Gold fever.
Gold fever. That's exactly right. That's exactly right. So but yes, Olin, I think that's a fair assessment. You definitely don't want to be putting your retirement dollars, your hard-earned money into Bitcoin. If you want to put your lottery ticket money into Bitcoin. How's that? Okay, to the extent that you've got lottery ticket money, take some of those lottery ticket dollars and shift it over to Bitcoin, I suppose.
Those people have to open an account, correct?
Oh yeah. It's not. That is absolutely correct, and it's a lot more convoluted than that because the way you get a Bitcoin, and you can still earn Bitcoins, is through solving some pretty extensive mathematical calculations that then unlock sequences that allows you to get the reward as you unlock the blocks. What's fascinating about Bitcoin is the technology behind it is actually pretty interesting, but how they've got it is that you've got to solve the problem. It takes a ton of computing power to solve it. I think mining, the article I was talking about 3 or 4 weeks ago, the notion of mining Bitcoin, it consumes more power than what the country of Ireland consumes in a year. So it's very heavy computing stuff that in order to mine it, in order to sort of find it, and then once you unlock it, then you have the currency. But be careful because it's easily tapped into and stolen because it's untraceable. I mean, that's the cachet about it, is that it is used pretty much by the underworld, if you will, because it is an untraceable transaction. So it's very hard to kind of maintain possession of the Bitcoins unless you're very cautious on the security on it.
Yeah. Okay.
Interesting stuff, Owen. Thanks for calling in and contributing to the program. We certainly appreciate that. We're going to take a break. When we get back from the break, we will talk a little bit about Social Security, hopefully get to this pass-through stuff on some of the rules on that. And then, of course, we do have open lines. So 407-916-5400, toll-free 1-855-545-1025. Those are the numbers to call on in and be a part of the program here on News Radio 102.5 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, Dollars and Cents. This is Joel Garris of Nelson Financial Planning here on News Radio 102.5 WFLA. Good Sunday morning to you here. Covered a lot of territory in the program. In this last segment, we wanted to chat a little bit about Social Security and the annual statement that you, I guess, used to get, but have not perhaps gotten in a number of years. It's it's probably a pretty important document in terms of planning for your retirement. For a period of time, they used to be sending those statements to every person, but in 2011 suspended those mailings because it, of course, costs money to send those statements. And then in the next year, 2012, they decided to restart them for only for people over the age of 60, and then they were halted later that year again. So perhaps you may be wondering where it is. You used to get it and you don't get it now. The statements are mailed out only to people that are age 60 and over, assuming they haven't filed for benefits, and most importantly, they have not established an online account. So one of the big comments on this topic is if you aren't receiving your paper statement or you've lost them, we would encourage you to, at the very least, register online with Social Security Administration to make sure that you are getting or at least get copies of those, because they are part of the process for planning properly for your retirement. They've also got a lot of good information, which we want to get into, but of course, we always want to get to the phones first. So we will go to the phones. And we got David in Orlando. Hey, good morning, David. How are you?
Good morning, gentlemen. How you guys doing?
I'm doing great.
Great. My question is, got a letter for 2016 from the IRS saying I owe basically another $7,800.
Oof.
Which I, don't have that, wasn't expecting it. I have a SEP account which has, I think, about $105,000 and a Roth IRA that has like $39,000 in it. Now, I want to get this past me, should I sell some of probably the Roth just to get this out of the way?
Between the two, that's probably the better option. But let me rewind the conversation just a little bit. So, David, when you got this letter from the IRS, do you understand what the issue is, and are you agreeing with their assessment?
According to my accountant, yes.
Okay. All right. So we don't have an argument, because sometimes those letters, if you dig into them, you may find that. Because those are just computer-generated letters. So sometimes the computer doesn't know everything. And so consequently, it's always good to make sure that you really do, in fact, agree with what their analysis is. So if your accountant is saying, well, yeah, okay, you got to pay it, then between those two options, the SEP versus the Roth, how old are you, David?
53 and a half.
Did you say 63 or 53?
53.
53. Okay. So, yeah, taking it out of the SEP, obviously that's taxable plus a 10% penalty. With the Roth, you can take out your original contributions, and that will not create any tax issues. So you said the Roth was how much?
Probably $39,000.
Do you recall how much you've put into that account? Has it been at least $7,800?
Oh, yes.
Okay.
Yeah, I've been contributing to it for years. Whatever I can maximize, like $5,500 one year and $6,000 one year and $4,500 a few years ago. And
perfect. So those contributions you can take out, and that will not trigger any tax consequence. So to the extent you want to just get rid of it and wipe the slate clean, then grabbing some money out of that Roth will not create any tax consequence for you, because you've got some capital contributions that are in there. Those capital contributions were all done on an after-tax basis, and you're allowed to take those out without any taxes or penalties. So you've got some options there. The other option, David, is to go into a payment plan with them. I mean, their interest rates are pretty low, so you can also do that, and you can set the payment plan with them at whatever number you want. So there's some flexibility on that in terms of a payment plan.
Yeah, that's what I responded by saying I would like to start a payment plan, but I just, I've heard enough horror stories about the penalties and interest, even on a few $1,000s. That it seems like they penalize you on an hourly basis.
Well, the penalty is already sort of kind of kicked in. Going forward, once you're doing a payment plan, it's really just the interest part. So I would run the numbers on that and kind of see if it's 7,800, I think you said it was. So
yes,
just see what the total amount of those payments might be over time, and have them kind of run, kind of a total total number. I know they're hard to get a hold of to actually talk to somebody, but if you've got some time to sit on hold for a little bit, having a conversation with them might be a good way to make sure you've got all the numbers in front of you to make the best possible decision on it. Because I can tell you the interest rate is pretty low on those.
Well, that's good. I didn't think that, though.
Yeah.
Good.
Definitely have a conversation with them, David, and just make sure you got all the ducks in a row. Add up all those numbers, and if it's a big number, then maybe you got to tap that Roth. Although I don't like that, I never like raiding that retirement account for that. But the IRS is no fun to deal with. They're they kind of. They got the taxing authority.
And I heard there's like however many thousands of government agencies, and it's like the only government agency that's never been audited.
Well, that may be a conversation for a different show, David. We appreciate the call, and thanks to Olin and David for touching in with us, calling in during the show. We appreciate that. We will continue the conversation next week on the program, talk more about Social Security. And also, I didn't quite get to the pass-through rules, so we're going to talk to about that. So we're always got something to talk about here on Dollars and Cents. This is Joel Garris, Nelson Financial Planning, News Radio 102.5 WFLA. Fees, commissions, expenses, investment costs come in all shapes and sizes. Do you know how much your investments are really costing you? At Nelson Financial Planning, we believe that costs should be a major consideration in your financial plan. After all, the lower your costs are, the more you get to keep for yourself. This is Joel Garris, and I invite you to get educated about your investment costs. Visit nelsonfinancialplanning.com or call us today at 407-629-6477 to set up a personal conversation to review your investment costs. That's nelsonfinancialplanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC at FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 102.5 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.